Welcome to CalCPA's Tax Bill Series. I'm Chris Bell with Baker Tilly, and today we're breaking down some key tax and healthcare updates you need to know. The One Big Beautiful Bill Act, which was signed into law on July 4th, 2025, has several key areas that impact healthcare and benefit tax issues. First, we're going to cover HSA and FSA changes. For health savings accounts, one key area has to do with telehealth. Under the CARES Act in 2020, it temporarily allowed high-deductible health plans to cover telehealth and remote healthcare services from the first dollar. That meant that people receiving telehealth services did not have to spend some of their deductible payments before they could receive that care. So essentially, it allowed them to reduce the cost sharing or eliminate the cost sharing on telehealth and remote healthcare services, but that was only temporary. The One Big Beautiful Bill Act extends this to make it permanent, beginning with plan years that start in 2025. A few other changes to health savings accounts. The One Big Beautiful Bill Act allows participants to enroll in direct primary care arrangements. This is where you might pay a monthly fee or subscription to have direct access to a primary care physician. And there had been temporary rules issued in 2020 indicating this would not be allowed. Those rules were never finalized. The One Big Beautiful Bill Act does clarify that those can be allowed with an HSA plan, but only if certain conditions are allowed. Are met. We're not going to go into those conditions on today's call, but do want to highlight that you have to make sure that the monthly cost is below a certain threshold and that the services provided do not include certain prohibited services. Finally, on the health savings accounts, the bronze and catastrophic individual health insurance plans on the marketplace exchanges will automatically be treated as high deductible health plans for purposes of being eligible to participate in an HSA. So that's great news. If you go to the marketplace and you obtain one of those two plans, you'll automatically be eligible. That's effective in January of 2026. One item to note, if somebody obtains similar plans outside of the marketplace, they are not automatically eligible for the high deductible health plan requirement to participate in an HSA. So something just to be mindful of. How you obtain the plan is important here. On flexible spending accounts for dependent care FSAs, typically used to cover child care, when that rule was passed in 1986, it was never pegged for inflation. So starting in 2026, the FSA amount that can be contributed will go up from $5,000 to $7,500 for most taxpayers. For taxpayers who file married filing separately, it's 1/2 of that amount. So $2,500 is what the old limit was, and it will go up to $3,750. The One Big Beautiful Bill Act changed the premium tax credit rules. Originally, under the Affordable Care Act, there are premiums that are allowed to be covered by the federal government, and they're treated as tax credits. Originally, these allowed for auto re-enrollment. That auto re-enrollment will no longer be allowed starting in 2028. What this means is that individuals who are receiving premium tax credits beginning in 2028 will have to verify their household income, their immigration status, and their place of residence at least annually. It also has a change beginning in 2026 regarding repayment of excess premium tax credits. So the premium tax credit is originally issued based on an estimate of your income for that year. If your income turns out to be much higher, it could be that your premium tax credit you should have received would have been smaller. Under the old rules, as long as your income was below 400% of the federal poverty limit, there were caps on how much you would ever have to repay if your income was a little bit higher than what had originally been expected. Under the new rules, beginning in 2026, any excess premium tax credit will have to be repaid in full as long as your income is over 100% of the federal poverty limit. And so this raises the stakes, so to speak. for individuals who provide estimates of their income that turn out to be understated, where they may have to repay more of that premium tax credit that was more than they should have received. There's some Medicaid-linked implications around the One Big Beautiful Bill Act. Now, this is more of an indirect change or indirect impact to employers in particular and individuals who participate in Medicaid programs. Medicaid is a state-run program. In the state of California, it's referred to as Medi-Cal. What the One Big Beautiful Bill Act does is limit federal matching dollars that go towards the state Medicaid program. Now, this is not an across-the-board reduction in the funding. It is towards very specific groups of participants, those with certain immigration status, those certain working adults who can't prove or demonstrate that they've worked a certain number of hours or have done other things to demonstrate they were seeking work. And so as the federal government reduces some of that funding, the expectation is that there will be people who were previously covered under Medicaid who will no longer be covered under Medicaid. Well, what does that mean for an employer? Well, it means that as the healthcare system has more patients who come through which don't have health coverage and don't have the ability to pay for healthcare, but receive healthcare nonetheless, there's higher unreimbursed healthcare costs that those hospitals and health systems and medical groups and dentists have to cover. And that can have an inflationary impact on the cost of employer-sponsored health plans. So as employers renew their health coverage each year, they should be watching out for higher than normal inflation. Now, it's hard to predict exactly when this will occur because it will take a little bit of time for these Medicaid funding changes to go into effect. But employers should be on the watch out for that. Finally, I want to just highlight a few changes to the employer coverage models that were included in earlier versions of the tax bill, but didn't make the final cut. So these are items that were reported in the news. You may have seen in some of the preliminary summaries of the legislation, but were not in the final legislation. Individual health reimbursement account arrangements, which are sometimes referred to as ICHRAs or as choice arrangements, had been included in the House bill. They would have codified these arrangements. They would have allowed choice participants to purchase some coverage on a pre-tax basis on the exchanges using a cafeteria plan. And at one point, even had provisions to allow for employer tax credits related to choice arrangements. This did not make it in the final legislation. So it's an area that Congress may revisit in the near future, but at least for now, there's no change to the individual health reimbursement account arrangements. At one point in the legislation, there was discussions around having tax-free HSA reimbursement of fitness and exercise programs. That did not make it in the final legislation. And lastly, there had been a discussion of increasing the HSA annual contribution limits with phase-outs for higher earners. This also didn't make it into the final legislation. And so with that, we just want to make sure people are aware, as they may have previously read about some of those provisions, that those did not go into effect. I'd like to thank everyone for joining us and be sure to stay tuned for more episodes.